Hi everyone, welcome back to the channel. I'm Kirill Talai, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today, I want to talk about why I think caution is warranted right now. Even though the economy looks fine, we've got three stories to cover today. First, Iran, the near-term risk I think most investors are underpricing. Second, the AI disruption trade and what it means for software stocks. And third, the economic data and what it tells us about where we're headed. Let's get into that. But before we do, a quick disclaimer. Nothing on this channel is financial advice. I'm sharing my views and analysis, but always do your own research before making any investment decisions. Let's start with what I think is the most underpriced risk in the markets right now: Iran. The US has assembled its largest military presence in the Middle East since the 2003 Iraq invasion. 2 carrier strike groups, dozens of combat aircrafts, a massive naval deployment. The signaling from the administration has been mixed. It seems like they are preparing for 3 possible scenarios: a diplomatic solution, a limited strike on military or nuclear targets, or a prolonged military action. The diplomacy still has a chance. Talks are ongoing, but the range of outcomes is wide. Meanwhile, Iran is going through its worst internal crisis since the 1979 revolution. Various sources report that thousands were killed in protests last month. Students are protesting again at universities across Iran. The regime is under enormous pressure, both domestically and from Washington. Oil is already responding. Brent crude hit a 6-month high above $71 last week. But the equity market barely moved. And I think that disconnect is the key point here. So I went back and looked at how prior Middle East conflicts played out for markets. And here's a very consistent pattern. In 2003, the Iraq war buildup was enormous and took months. Everyone knew the invasion was coming. During that period, the stock market steadily declined. Uncertainty was weighing on everything. Oil spiked. But then, when the invasion actually started, the market surged. It was a textbook: sell the rumor, buy the news event. The quick resolution led to a strong rally. Oil prices collapsed, and the Fed got room to ease. You saw the same dynamic in 1991 with Desert Storm. Iraq invaded Kuwait, markets sold off for months. Oil spiked. Then, when the US-led coalition went in, markets rallied, and oil came crashing back down. So the historical pattern is quite clear. Markets sell off during the build-up and then rally at the outbreak, especially if the conflict is quick. But here's what makes today different and why I'm more cautious. In both 2003 and 1991, the build-up was well telegraphed over months. Everyone was watching. Markets had time to gradually price in the risk. This time, that hasn't happened. The S&P 500 has barely reacted to the Iran headlines. Investors have been focused on AI disruption, the earnings seasons, tariffs. Iran has been just a background noise. So, if we actually get a military strike, I think the initial sell-off could be sharper than what history would suggest. The surprise element is higher precisely because the risk hasn't been gradually absorbed the way it was before. Now, there are a few things that could soften the market impact if a conflict does happen. The US has shifted from being a major oil importer to the world's largest oil producer. So higher oil prices actually benefit parts of the US economy now. That wasn't the case in 91 or 03. On top of that, there is an oil supply glut this year, which puts a natural cap on how high prices can go. And in both prior wars, the Fed treated the oil spike as transitory and focused on supporting growth. I'd expect the same playbook if it comes to that. Well, Trump historically prefers short, decisive actions where he can declare victory. So if something happens, it's likely brief. And a brief conflict would probably follow the historical pattern, a sharp sell-off followed by a quick recovery. But war opens Pandora's box. If it drags on, those historical analogies break down completely. So, my take is simple. Keep some dry powder. Don't be fully invested going into what could be a very volatile few weeks. Okay, so that's the near-term risk. But there is also a longer-term structural shift happening right now, one that's already reshaping which sectors win and which lose. And that's the AI disruption story. The software sector is in free fall. The IGV software ETF is down over 30% since its October highs. It just posted its worst month since October 2008. And it's not just the index. Salesforce is down 33% year to date, or 50% of the past year. Adobe is back to 2018 levels, basically erasing 6 years of gains. JP Morgan estimates roughly $2 trillion has been wiped off software market caps in total. Now, Wall Street is divided. JP Morgan, Morgan Stanley, Cathie Wood, they're all saying the sell-off is overdone. They compare it to COVID, calling it a buying opportunity. Well, I don't necessarily agree here. Elon Musk has used the phrase supersonic tsunami to describe AI disruption. It's moving so fast and so much structural power that it destroys everything in its path before investors can react. And I think that's exactly what we are seeing. This isn't a cyclical dip, it's structural. And let me explain why. The real threat to software isn't that people are buying less of it. It's that AI has made building software almost free. With what people call vibe coding, where you just describe what you want and an AI builds it for you. A product that used to make a team of engineers and millions in funding can now be built by one person over a weekend. That doesn't mean fewer software companies. It means 10 times more. More competition, margin compression, higher customer acquisition costs. The scarcity premium the software commanded for decades is evaporating, in my opinion. And the disruption keeps spreading to new sectors. A few weeks ago, it was legal software. Thomson Reuters dropped 28%. Then it hit insurance brokers, wealth management, commercial real estate services, trucking, even cybersecurity, which many thought was the safe haven within tech, got hit after Anthropic released security tools that sent CrowdStrike and peers lower. Every week, another industry is asking, are we next? There is an analogy to a newspaper in the early 2000s that I think is worth considering. When the internet disrupted media, newspaper stocks didn't bottom until earnings estimates bottomed. The multiple compression came fast. Investors saw the disruption coming and repriced the stocks lower. But then the actual revenue decline followed, and stocks fell further. I think we're in the early stages of that same pattern with software. Multiples have crushed, but earnings are still holding up. History suggests the earnings decline comes next. Can software bounce from here? Yes, of course. The sector is technically oversold, but I wouldn't be a hero trying to catch the falling knife, at least not on the aggregate level. And I think this connects to what's going to be one of the defining investment themes of the next several years, the rotation from abundance to scarcity. AI is making software abundant. Anything that can be digitized and replicated at zero marginal cost is getting commoditized. The value is collapsing towards zero. But what AI cannot create? Physical resources, energy, metals, infrastructure. Those become relatively more valuable as everything digital gets cheaper. The market is already showing you this. Industrials and metals are among the best performing sectors here today. Materials are up. Meanwhile, the Nasdaq is flat to down. The money is rotating from digital to physical. And I think this is just the beginning. If I had to summarize the trade in one line, I would say long scarcity, short abundance. So we've got near-term geopolitical risk from Iran and the structural shift from AI disruption. But here is the thing. All of this is happening against a macro backdrop that's actually pretty solid. And that matters for you, how you're positioning. The economic data in February came in better than expected across the board. Let's take inflation. CPI hit 2.4% year over year, lowest level since May of last year, below what the street was expecting. Manufacturing. ISM PMI came in at 52.6. We've been stuck in that 47-50 range for a while going now. This month, we broke out, jumped almost 5 points, highest reading since August 2022. Jobs. Non-farm payrolls at 130,000, more than double expectations. Unemployment ticked down to 4.3 from 4.5 just a couple months ago. Remember when everyone was worried about a sharply deteriorating labor market? That fear hasn't materialized. So, the picture is growth picking up, inflation coming down. From a pure macro standpoint, that's a good environment for risk assets. Quick note on tariffs. The Supreme Court struck down Trump's IEEPA tariffs last Friday. Markets rallied on the news, but Trump moved fast. With ours, he put a 15% tariff on under a different authority, Section 122. That's the maximum allowed under that law, and it expires, I think, in 150 days, until the administration takes next steps. So, tariffs haven't gone away. But what I think is more interesting here is the negotiating dynamic. Trump's position just got weaker. He can no longer threaten those big tariff numbers the way he could under IEEPA. The EU and China know this. And China, in particular, could get more aggressive, potentially pushing for better terms than what they agreed to in the fall, like demanding access to more advanced chips in exchange for the same concessions. That's something to watch. The power dynamic at the table has shifted, and I think this might be one of the reasons metal have started moving again. The market is recalibrating what trade policy actually look like from here. But the bigger point is this. The economy is solid, the macro setup is supportive, yet the risks aren't coming from the usual places, let's say. They're coming from geopolitics and structural disruption. A strong economy doesn't protect you from a military conflict in the Middle East or from AI reshaping entire industries overnight. That's why I think caution is warranted, even when the data looks good. Okay, that's it for today, guys. Let me know what you think in the comments. Like, subscribe, turn on notifications so you don't miss the next one. See you.